All right, let's go back now to our panel. We got Jim, Francis, and David. Francis, I want to go to you because let's talk about the job market. And I'm going to compare the last meeting minutes, and you'll forgive me, I got to look down and read it. Here's what they said at the last meeting minutes about the job market. They said the unemployment rate is edged up, but remained low through August. So they said, oh, okay, it's edged up, but it's low. This year, first paragraph, the unemployment rate has edged up through September, hard stop. So they seem to be acknowledging that the job market has weakened a little bit. I guess that changes the odds of a potential rate cut.
I like your word a little bit, because if you look at a chart of the unemployment rate going back to the 1970s, it's only been this low 2 times over that period, Brian. So I'm wondering why this is suddenly not low, particularly that we've only seen what I would consider a normalization in the labor market. In particular, this hasn't been broad-based across all age groups. It's been really focused on young individuals in the United States. So is this really a labor market that's quickly deteriorating? It doesn't look much like that much-feared hockey-shaped movement to me. Meanwhile, inflation has been above target for 55 months. So if I was looking at the bulk of the data and I looked at that dot plot and I looked at the Fed's forecast today, I would be saying, oh, they must have decided to hold or hike in that type of environment. What I want to hear from Powell during this press conference is, how the heck did you convince this committee to end with a cut today?
David, did they convince it? We had 3 dissents.
Well, no, and it sounded like we could have had 6
More.
dissents.
6
dissents.
They dissented on what they call the dot plots, which I hate that term. It's like the Fed's light bright, where they put in where they expect rates to be. 6 non-moves on that, 3 actual dissents. So 3 people, I'm sorry, I'm going to say this, 3 people chickened out. Well, they wouldn't go on the paper and say, I disagree.
Well, exactly. And you can see that from the language in some of the speeches that we saw after the last Fed meeting, which actually convinced markets they weren't going to cut today, because some of the, particularly the regional bank presidents, are really hesitant to cut, at least in what they say. But then when it comes to it, they give the kid another cookie. And actually, it's a slightly bigger cookie than expected, because they got this extra liquidity for the short end. But I do think this is, more dovish short term, but still pretty hawkish long term, because if Steve's reading of this is right, they've upped their estimate of GDP growth next year by a lot. We've got all these income tax refunds that are going to kick in the first half of next year. That's going to push growth higher, regardless of what the jobs market is doing right now. And it sounds like there are very few members of the Federal Open Market Committee who want to do more than 1 rate cut next year. And if you're only going to do 1 rate cut in the year, when are you going to do it? Maybe you wait all the way until December. So we're going to have it's going to be interesting here with the Fed perhaps going on pause in the first half of next year.
All of that said, maybe we can put this on the screen. The tech ETF, we were talking about this yesterday on a 12-day win streak. Well, it's now in the green after this move up to possibly have a 13-day stretch that would be its longest in about 8 years. So that's meaningful. We also have silver and gold on the positive and on the rise. Jim, Caron, I was just going to bring you in on this, because it seems, and I think John Spallanzani's phrase captures this perfectly, that he calls it, says, the repo vigilantes won. Because the big headline for a lot of people, even those who are more bearish on bonds, is the Fed's back, they're buying, and they're doing so. Maybe it's just bills, but it's significant that this action is now coming a little bit more quickly than people thought. What does it tell you?
Hi, Kelly. Listen, I think that's a great way to frame this. On balance, this, to me, is a more dovish meeting. Now, yes, it is true, and I would really say that this is ironic, right? And I think we have to see the irony in this. The Fed has basically raised the bar for the next rate cut, right? So we still think they're going to cut, but it's going to be a higher hurdle for them to do that. However, they did surprise the market on the dovish side by moving that balance sheet management from what many people thought was going to be early next year to actually what's going to happen starting, right now here in December. The Fed is basically telling us that they want to have pro-cyclical policy, I mean, they want to support the growth cycle. They're going to stand at the ready to cut interest rates if the labor market deteriorates further. And at the same time, they're worried about liquidity. They want to add liquidity back to markets. Call that reserves, call it what you will. The point, though, is that we need to get over the year-end turn, right? So liquidity constraints might come in at the end of the year. And the Fed wants to avoid that type of a stress in the marketplace. So net, the fact that they're willing to start to inject this liquidity, worry about reserves, and that's a lot of what's going to maintain, I think, some of the bullish sentiment in the markets, which is what we're seeing reflected, is actually the net dovish component, even though they raise the bar for the next rate cut. So I think it's a bit ironic.